wouldn't want to be overly kind of relaxed about inflation. I think it could be something to worry about, but I think the real problem is like sorting out what the structural scarring to the economy. Whole industries are now likely, potentially changed, and people's jobs may be lost. You've got to sort that out, and I think a Green New Deal is the way. Making sure we are creating enough quality, socially useful jobs. I think it's an opportunity to be doing that, and that is getting that right is more important than worrying too much about temporary rise in inflation. And as I said before, like the big kind of inflationary drivers still, we've ignored. The places where inflation are happening in asset prices, in house prices. Mm-hmm. That is, what policymakers ignore. And yeah, that's, one of the reasons why the financial crisis was so bad, because we've kind of, taken the eye off what was happening to asset prices.
Hi everyone, thanks so much for tuning in. Before we get started, I just have a few short messages. First off, don't forget to like, share and subscribe this podcast. It's the best way to help us grow and help me get on bigger and better guests. Also, don't forget you can pre-order my book, To the Moon, The GameStop Saga, right now by following the links in the description below. We've also got a few quick sponsors for the show today. Comedy is a really crucial art form, especially in a world where government power seems to be rapidly expanding. It's one of the most effective ways to speak truth to power. And to that end, today I bring you the Behind the Bits podcast with Scott Curtis, a podcast about the tragedy and triumph of stand-up comedy. Every week, Scott has a new comedian on the show to talk about inspiration for their comedy, the struggles of the industry, and how they find themselves stumbling into the world of comedy. In one of my favourite recent episodes, Scott spoke to Liz Mail, a New Jerseyite who began comedy at 16. The show can swing between hilariously funny and incredibly poignant at times. She spoke about realising the problems you had as a child in retrospect, smoking weed as a waitress, mental health, breaking rules, and the wild rollercoaster of performing on stage. You'll get Behind the Bits wherever you find your podcast. Apple, Spotify, and more. That's Behind the Bits with Scott Curtis, the best podcast to get to know the people behind the jokes. The Growth Manifesto podcast is Australia's leading business, marketing, tech, and entrepreneurship podcast. I've often said that great guests make great podcasts, and this is never more true than with the Growth Manifesto podcast. They've done an incredible amount of in-depth interviews, some of which I'd like to highlight here for you. First off, Jay Abrams. He's a legend of the marketing world. He's helped more than 10,000 clients in more than 1,000 industries solve complex problems and drive significant growth. His clients include Tony Robbins, Microsoft, and HBO. So if you're struggling to sell yourself or your business, then this is the podcast for you. But that is just one episode. They've covered why blockchain technology will change the world with Tim Draper, a leader in the cryptocurrency space, AI and automation with Pascal Bornet, the author of Intelligent Automation. And for all of the Wolf of Wall Street fans out there, they did an episode with Jordan Belfort himself on sales and closing. Say what you will about the questionable business practices or his previous love of shoveling illegal substances up his nose, the man knows how to sell. You'll get the Growth Manifesto podcast wherever you find your podcasts or by following the link in the description below. That's the Growth Manifesto podcast, Australia's leading business, marketing, tech, and entrepreneurship podcast. Links for everything will be in the description below. So check them out and then please enjoy the podcast. How would you like to be introduced?
I don't know. I've never done a podcast before, I think. So.
What did you say? You were Head of Policy at Positive Money?
Head of Policy and Advocacy.
And Advocacy, okay.
It doesn't really matter.
Well, you want to give the best representation of yourself.
Sure.
And it's Youel, right?
Yeah.
I'll get rid of that book. I don't want that anymore. Let's get that out of the way. Lovely. So, awesome. Right, let's go. Hello and welcome to another episode of Chatter. Today I'm here with Simon Youel, who is the Head of Policy and Advocacy at Positive Money. Simon, welcome to the show.
Thanks for having me.
Yeah, not a problem. So why don't you give people like the elevator pitch for Positive Money to give them an idea of what you do there?
Sure. So I guess the classic tagline we've used is we're a research and campaigning organisation working for a money and banking system which supports a fairer, more democratic and sustainable economy. So that's the pitch in about 10 seconds. But I can understand, that might mean a lot of different things to a lot of different people. So I could talk maybe a bit.
Yeah, but we've got loads of time, man.
Sure. I guess in general, like what we do and what I've just said can mean a lot of things. So we work on a range of things, mainly about looking at, the money and banking system and seeing how it can essentially be reformed or even, transformed to meet public purpose. So this could be, having public forms of banking, public access to digital currencies, to transforming it so that we no longer have an economy built on growth and GDP growth and moving within planetary boundaries. So we see like the money and banking system as a key kind of pressure point and also key lever in building a fairer society, because so many things about our society and our economy are shaped by the way the money and banking system works and the decisions made by big finance. So we're looking to try and democratize that and bring it within power of the public to be able to have more kind of control over what the banking system does, and being able to build more sustainable models of finance. So quite wide, yeah.
Do you think that, and this is a conversation I've had with a lot of people, do you think that growth is incompatible with? Do you think growth as such is like an inherently bad thing? Because I've seen people make this argument, and I understand exactly where they're coming from in terms of like finance, because I think it's Nicholas Shaxson in his book, and it's not his study, but he quotes this figure and it sticks in my mind. I think he said it was 4.3 trillion pounds of growth has been lost by the rest of the economy as a result of this
finance curse.
The finance curse, essentially. It's the principle for anyone that doesn't know, that hasn't listened to my episode with him, go check it out, is that finance has become a drain on the resources in the same way oil or copper or anything like that would be on a developing nation. You see the resource curse in other places, and he sort of points to the finance curse as being just as big a drain on the British economy. But to me, that doesn't inherently mean that growth is a bad thing. Do you disagree?
Well, the argument about growth is that, it's really, okay, so when economists or policymakers talk about growth, the reason they're doing it is because, they think if you can grow the economy, that makes everything easier, right? There's more to go around to everyone. So instead of like talking about dividing the pie between people, if you grow a bigger pie, people can in theory have more. I guess the issue is just kind of bluntly trying to grow the economy through whatever means necessary means that you're using huge amounts of resources, which we know we live on a planet which can't support infinite extraction of resources and infinite growth. You're using more than the planet can support in order to support this growth. But also, growth isn't actually very good at meeting the kind of objectives or goals you have as a policymaker or as a society. So the best way of fixing problems with the economy or with people's living standards isn't just growing the economy. It's about directly fixing and tackling those problems, whereas growth is seen as a kind of indirect way of doing that. If you just grow the economy enough, we'll trickle down and everyone will be better. But we know that leads to environmental degradation, that leads to huge inequality. So yeah, I mean, there's a range of reasons why you might disagree with growth, and there are a lot of counter arguments too. But either way, I think most people can agree GDP as a concept is a very bad measure, and it isn't very useful. It doesn't really tell us that much. There's that famous a member of the public said to, I think it was Andy Haldane, the chief economist at the Bank of England, when he was making a speech about growth and saying, we've had 10% growth over the last 10 years or something, and a member of the audience stands up and says, well, that's your growth. We haven't experienced any of that because growth, GDP of the whole country doesn't tell you much. I mean, especially if it's all concentrated in London, doesn't tell us much about what people's lives are like outside of, in places which are left behind and are, seeing their living standards fall. So it's a very crude measure, and, doesn't tell us much about things that, you can't put a price on. Like the things that really matter, right? Like, well-being and things like, the domestic labour and things like that. They're not included in growth statistics, but those are some of the most important things that we need as a society to function. So I would say it's a poor measure, and focusing on it. And I guess where we come into it is, the fact that we're dependent on growth because of the way our policy institution, our policy making works. If we were to have a recession, so a fall in growth, people would be unemployed because there isn't that safety net otherwise. So we want to talk more about having an economy which is less dependent on growth, and we can meet people's needs without relying on growing the economy and therefore wrecking the planet or causing inequality. So I guess we originally came at it from looking at the financial system and how basically debt creates a growth imperative. So if you create lots of debt, you need to be able to pay off that debt, and you pay off that debt by extracting more resources and exploiting more of people's labour in order to pay off the debt. So you need a bigger economy to pay off the debt. So finance can create that growth imperative. So that's kind of a broad kind of brush of where we're coming from when we're talking about growth and potentially the issues of it.
I guess maybe this is like a too idealistic a view of it, but my hope is that it's for example, there's a lot of talk in America and also in Britain about this idea of the Green New Deal, which I'm broadly in favor of. I like the idea that we could take the power of state spending and use it to invest in, say, electrification of railways, expanding public transport, put in solar panels on every available space that you can find. I do not understand why that is not priority number one. And people talk about spending on climate change related things, and I'm just like, the government could literally just decide that 40% of their budget was on solar panels. And for me, that still would be growing the economy, but not in an extractive way.
Yeah. So I see the argument, people talk about, differentiating between different kinds of growth. Right? You can have particularly extractive and, harmful growth in terms of, we're just growing the economy as it is, which is dependent on fossil fuels. If we could talk about growth in green kind of alternatives, that would be better, right? There are some things we need to grow, we need to grow our capacity to respond to the climate crisis and the social crises facing us as well. But the way we do that is not through a generalized growth of the economy, because that will always create more kind of pressure on the environment. Even solar panels, for instance, those have a huge environmental, lots of green technologies, rely on extracting these rare earth minerals from the global south. And, for instance, people talk about electric cars. Well, from what I've heard, it would require double the amount of cobalt we have on this planet to just replace every petrol car with an electric car. So I think there are kind of these fantasists who, Elon Musk style people. I mean, I don't want to disparage. You might be a fan of him. I don't know.
I think he's a net good.
Okay, fair enough. But I feel like he's a kind of this utopian technologicalist, like who thinks, we can just, have technology, new forms of technology to maintain our current system. And I think, we need to actually talk about changing our ways of life as well as, you can't just rely on technology. We do need to change our system, and so it's less, wasteful and more sustainable.
The one thing I would say is there's a cool bit of tech coming out of China at the minute that is a cobalt-free battery, which is has the potential now. So I think it's just they're working on. They've got like prototypes out, and they don't have like the full. It's not in production yet. But instead of being like a wound battery, it's a square one that allows for far more ventilation, and it's cobalt free. So that's the kind of technology that I would look at. That would be hopefully allowing us to grow in a non-damaging way, essentially. But so Positive Money would advocate for trying to invest in these industries with quite a substantial amount of money. And one of the things that I've seen Positive Money advocate for is using the power of quantitative easing to fund spending on transforming our economy. Do you want to give people an idea of what quantitative easing is, and then how that would work in terms of trying to use that power to spend on infrastructure rather than pumping money into the top of the stock market?
So, quantitative easing can begin to get quite complicated quite quickly. The Bank of England, that they really recently, got told by an independent evaluation that they don't understand quantitative easing.
What?
Or they failed to communicate how it works.
Okay.
Because it is, a relatively new policy tool, and the scale that's been done on recently is, quite unprecedented, and no one really can claim to fully understand all the effects, because there are, various theories as to how it works, and various kind of second order effects and consequences that can come from it, and these can be debated. But I can try and explain practically what it means. So quantitative easing. So when the government borrows money, it issues bonds. These bonds are usually bought by the private sector, so pension funds or other financial institutions. So what quantitative easing involves is the Bank of England creating new money to buy these bonds from these companies. So instead of these companies having government bonds, they now have a load of cash, basically. And the idea is that this would, injecting all of this new money would increase asset prices, so increase the value of these bonds, which would make, first of all, there's this kind of wealth effect, trickle-down effect. And the Bank of England's explained it in this way before itself, like make the holders, the people who previously or hold government bonds, feel wealthier. And people who hold assets like property in general feel wealthier because there's now more money in the system pushing up asset prices. So they would potentially spend more or invest more because, they are wealthier, they feel they're more able to do that. A kind of second related channel to this is like the portfolio rebalancing effect. So the idea that, these companies, like pension funds, for example, no longer have these bonds on their balance sheet. They've got a load of cash. So they're going to reinvest the cash into something else. So the idea is that cash might get invested into something useful or productive, which would boost the economy. The problem there is that, if they can no longer invest in government bonds, they'll invest in something equally safe, like property. So it means, a lot more money flowing to financial speculation or property markets rather than, the money actually trickling down to the economy. So it's basically based on this. It's a kind of trickle-down economics. The Bank of England basically floods financial markets with hundreds of billions of pounds of new money, with the hope that this money, leads to people shifting their portfolios around, investing in different things, and eventually that will reach the real economy. Or, people feeling wealthier, people who have assets, going out and spending because they feel wealthier. So that kind of wealth effect, trickle down economics.
Can I stop you there
for
a sec, just because I want to clarify exactly what you've said there before you move any further, just for both myself and people listening. So essentially what you're saying is the government hands out government bonds, and
So
then
it
the Bank of
exchanges.
England
Yeah.
comes in and buys them
Yeah, so
from the
basically,
companies.
yeah. So it's like, this is where it gets, I guess, potentially controversial, because what people might say the Bank of England is doing is financing the government directly.
Okay.
So creating new money, which is finance. So if they bought the bonds directly from the government, that would be a direct form of financing. They're essentially lending directly to the government. But what they're doing is the government sells them to the private sector first.
Okay.
And the Bank of England buys them on secondary markets off the private sector. So it's basically like a kind of a magic trick kind of shuffle, just to make it look like they're not funding the government. But that was never really the intention of quantitative easing from the beginning. Like, it's kind of changed over time. Like the idea of quantitative easing, the reason they did it was basically because after the financial crisis, interest rates were as low as they could go. There was no real means of getting banks to lend more because there's no incentive to increase your lending if interest rates can't go any lower. You can't. It's like pushing on a string. So basically, the Bank of England had to, because of the way most of our economic activity is based on bank lending, to make things happen. Basically, that's where most of our money comes from, as I imagine we might get into. But so the kind of principal channel with which policymakers might boost the economy is through getting banks to lend more. And so they couldn't lower interest rates anymore, so they had to just create loads of money and basically capitalize the banks indirectly and get them to start lending more. Didn't really work. It has led to massive inequality. But now we're seeing potentially during the last year, during the COVID crisis, year and a half actually.
Keeps going.
Yeah. So the government has borrowed huge amounts of money to pay for all of this, and the Bank of England has at the same time been creating huge amounts of money to buy those bonds the government has issued to borrow to fund public spending. So it looks like they're basically helping the government pay for things indirectly. And their argument, or the argument people would make in favour of that, is that this is helping the government spend more. It's like protecting the government from having a sovereign debt crisis, as like if bonds yields rise too much, that would be a problem for the government. So they're preemptively.
Okay, what would that entail?
Sorry, I mean, I don't want to say sovereign bond crisis really, because a sovereign government can't, if it has its own central bank, can't default.
So I mean more specific. So you said that if the Bank of England weren't buying the government bonds, that the yield would go up too much. What does that mean in layman's terms? Yeah, so basically government borrowing will become more expensive, right? Okay.
What quantitative easing does is kind of suppress the yields by, if you increase asset prices, that automatically means a fall in the yield as a percentage of the total asset. Basically what it means is the Bank of England making it cheaper for the government to borrow by like stepping into the market and buying loads of stuff up. Okay. So increasing demand for it, lowering yields. It gets it can sound quite technical, but essentially what it is if the Bank of England didn't do that, we could have a lot higher, and the government didn't do anything else to try and mitigate that. We could have a lot higher interest on government bonds, and that could lead to all kinds of issues with financial markets, which rely on government bonds as like a key kind of building block in the financial system.
So the yield on a bond is the interest that the government is paying on it.
Yeah. So
essentially, simplest terms. Yeah. Okay. So so we're basically saying that the Bank of England has the ability to just add money to their balance sheet, that they can just sort of go, well, we need £500 billion over the next 2 years. Let's just type that into the computer and then we'll say that we've got it.
They can do that, and they have basically done that. I mean, some people might say it's like an asset swap. They're essentially swapping these new central bank reserves, which are like highly liquid kind of assets, with government bonds, which are more kind of long dated. But essentially it's creating new money. So basically it puts to bed the argument that, there isn't enough money. We can't afford to pay for things because, we'll run out of money, basically. Because the Bank of England can always create new money. It's not always the best idea for it to do it. That's up for people to decide. But ultimately what it throws out of the window is this idea that, there is a limit on the amount governments can spend. Okay.
So how would positive money advocate using that power better?
I mean, so it depends what like context you're talking about. So like in the last decade of austerity, pre-COVID, what we really needed was better coordination between both the government and the Bank of England. So the real problem over the last decade pre-COVID was that the government was doing austerity, so basically cutting the amount of money it was spending, and then kind of relying on the Bank of England to make up for that and to prevent the economy going into recession by doing lots of quantitative easing. So what should have been done really was kind of the government not relying on the Bank of England to use pure monetary policy, but essentially both these institutions working together to increase the amount of fiscal spending the government did. And, that to make sure, it's that don't do austerity, invest to fight the recession. That's what they should have done. So, instead of...
It's quite classically Keynesian.
Exactly. Like it's not that controversial. And, instead of the Bank of England creating 445 billion as it did from 2019 to 2016, they could have done potentially much better with a lot less. So if the money was spent directly by the government. So if they gave, for instance, £50 billion to the government to spend, that money could have been spent on, investing in, tackling the climate emergency, or, investing in public services, all of those things. And the money would have actually gone to people's pockets. The problem with quantitative easing, the money stayed in the financial system, and that money doesn't really trickle into the real economy. It just gets passed around and reinvested into financial assets. So you didn't need to create as much money to basically keep the economy going and prevent the recession if the money was actually being spent. So you need a lot more money to have that same effect, by indirectly kind of trying to get the banks to lend more by doing quantitative easing.
Sorry. So you're essentially saying that the amount of money that was spent, and what did you say, 445 billion?
It's now like 895 billion.
Yeah, but the 445 figure I've seen, it was from, did you say 2009 to 2016?
Yeah.
Okay, so what you're saying is that amount of money is far more than would have been required to elicit the same amount of economic growth had you invested that in infrastructure, for example, rather than pumping up the asset prices that just benefits the wealthiest in our economy.
Yeah, I guess to put it this way, with quantitative easing over that period, for every pound they created, only 8 pence really seemed to make it into the real economy. So they could have achieved the same by putting 8 pence per that pound, whatever the maths works out at, about a tenth, into the real economy, and it would have had that same effect. And it wouldn't have led to increasing inequality. You'd be raising people's incomes, and you wouldn't just be inflating asset prices. So that's what they could have done. But they could have, if they don't want to decide who gets the money, they could have distributed it equally for households, and that would have been fairer.
I think the figure was £6,000 per household or per person.
The full 445 billion. That they might not need to do that. That could, be more inflationary. The problem a lot of central banks faced over after the financial crisis was they couldn't even get inflation up to target. So that's why they had to do as much quantitative easing, because generally after you've had a big financial crisis, there was like a tendency towards deflation. No one's lending anymore. People were just trying to like shrink their balance sheets and fix their own finances. And if everyone's doing that at the same time, the private sector does that and the government does that, you have a recession.
Today's episode is sponsored by the Growth Manifesto podcast, Australia's leading business, marketing, tech, and entrepreneurship podcast. The Growth Manifesto podcast is a Zoom web series brought to you by Web Profits, a digital growth consultancy that helps global and national businesses attract, acquire, and retain customers through digital marketing. One of the most interesting episodes for me of late has been an interview with Michael Sonnenschein, CEO at Grayscale Investments, the world's largest digital asset manager. After launching in 2013, they focused exclusively on digital assets, beginning with Bitcoin. And their goal is to offer the opportunity to invest in the cryptocurrency world without needing to rely on wallets or any of that newfangled technology that goes along with it. This is a crucial discussion to listen to for anyone interested in this space, as crypto will only go parabolic and change the world if it becomes widely adopted. So Grayscale's pursuit of this in the traditional world of finance is going to be crucial to making the step to widespread acceptance and adoption. In this episode, they walk through the history of the firm, why it was founded, and where they envision the company and the crypto space going in the future. That's the Growth Manifesto podcast, Australia's leading business, marketing, tech, and entrepreneurship podcast. Find it wherever you get your podcasts. Running any form of YouTube show or podcast can be really difficult at times. There is so much to keep up to date with, new platforms, SEO tricks, trends, and a whole host of new ways to market your show. Thankfully, for all of us overwhelmed creators out there, there is now a solution. Podcast Movement's daily newsletter. In the last few weeks alone, I've learned an amazing amount of stuff. They offered some fantastic podcast SEO tricks, gave me the heads up on YouTube's new subtitle editor, and recommended a free and amazingly detailed analytics tool for my podcast. The PodMove Daily is a free daily newsletter that is geared towards anyone who's a podcaster, looking to get into podcasting, or in the podcast industry. It goes out every morning at 11:15 Eastern, featuring fresh news, curated resources, industry announcements, and more. It's the best rundown of everything happening in the podcast world right now. And you can check out all of the most recent issues by going to podcastmovement.com/today's issue. And best of all, they've created a special landing page just for listeners and viewers of this show. You can go to podcastmovement.com/chatter. That's podcastmovement.com/chatter to check out their personalized page just for us. So if you want to be up to date on what is happening in the podcast world and get the best tips and tickets to keep your show growing, subscribe to the PodMove Daily Podcast from Podcast Movement. You won't be disappointed. Yeah. So one of the criticisms I've seen of this idea that we could just put that sort of spending power to better use is that it would drive up inflation. And because you are flooding the economy with extra money and therefore inherently decreasing the value of every pound that is in circulation at this point. What do you make of that criticism?
We're already doing that. There is already inflation, but it's for asset prices, right? The things which aren't measured under the Bank of England's remit, which is consumer price inflation. Mm-hmm. So things like property and housing and other financial assets. We've had huge inflation there because that's where the money is going, right? We could, see more inflation if all of the money went into the real economy. Sure, we'd have a lot higher inflation, but that's not necessarily what we're arguing for. If we could have had a smaller amount of money put directly into the real economy in a way which wouldn't have increased inflation, or would have kept inflation at target, and then you wouldn't have had the asset price inflation. And yeah, I mean, the thing with inflation, it's very difficult to even, central bankers don't understand it. And they tend to overestimate the amount of inflation we're going to have. No one really understands fully. There's all kinds of theories, I guess, on how inflation, maybe it's like kind of cost push inflation, or whether the money supplied is a determinant of inflation. There's all kinds of conflicting evidence on this. But yeah, I mean, I feel like what we're seeing, especially what we've seen over the last, I guess, under like the period of globalization, we've seen huge deflationary forces, especially in the Western world, because, I think manufacturing and industry has been exported to places where wages are cheaper, and we're importing these things at cheaper costs. So that's a huge driver of kind of a deflationary force.
As money flows out of the country.
Right? Not necessarily. It's more just the cost to produce things.
Okay.
Means, prices are lower. So you can buy a TV for half the price, for instance, that you could have if it was made in the UK. So things become cheaper, right? I think that's the best way to think of it. But I mean, I think, inflation isn't the biggest worry. The biggest worry is like unemployment and kind of spare capacity being wasted. And, I personally like, I don't know if you've come across the work of Lerner. He coined the idea of functional finance.
Okay.
And essentially, the role of policy, like monetary and fiscal policy, is to make sure that, there is enough money in the system to buy up all of the goods in the economy, and therefore achieve full inflation. Whether it's the private sector providing that money, or whether it's the kind of banking, the Bank of England or the government providing that money, it doesn't really matter. It's, if you basically, if you fix unemployment, and like inflation fixes itself, right? That is the main thing. And this is what, if you've come across this idea of modern monetary theory, it's quite similar. It's the idea that, inflation will kind of stabilize once you've got full employment. That's like the real thing to be targeting rather than inflation.
So one of the things that has been sort of in favor of modern monetary theory, and is kind of, in my mind at least, vaguely vindicated it, not really get to see the sort of very long-term effects of it, but has been the amount of money that we've spent over the past 18 months on, say, furlough schemes and the very successful world-beating test and trace program. And things like that. So it hasn't caused hyperinflation and crashed the economy as people sort of suggested that it might. But has what we've done simulated full employment in the sense that we gave everyone furlough payments, and a lot of people went on universal credit? Obviously that's not a lot of money, and hopefully they don't go through with that 20% or 25% cut. But would you say that's simulated full employment in a way, in that everyone has got some money to spend, and therefore it's that we've kind of
I guess it may have simulated potentially the demand side of full employment. Though I also kind of question that, because as you say, still people's wages will most likely be less. If they're on furlough, 80% of their wages means there is that's less demand. I guess what it doesn't do is simulate the supply side effects of full employment, which is that you would have more kind of you're increasing the productive capacity of the economy of full employment.
It sounds like growth to me.
Yeah, I mean, that's where these things. I mean, that's the thing. I try and avoid talking about a kind of degrowth stuff or stuff like that, because I find it difficult, to talk in the typical macroeconomic jargon that most people would be convinced by, that you have to speak to people, especially policymakers in. It's difficult because there are tensions there between are you talking about growth, but I mean, for me, my main priority is, making sure everyone has enough to live on. And, at the moment, if you're seeing cuts to universal credit, people getting put off furlough, people won't have enough to live on. And I think the initial impact of the pandemic we saw was disinflationary. So there was months where inflation went to like zero, and that was because people weren't able to spend as much. So yeah, I think like the reason things may change is because people come out and spend more. But looking at some of the Bank of England's projections and other projections, it suggests that sure, we might consumer demand might go up to where it was pre-pandemic, but it's not going to. There's no reason to think it will go up any higher than that. So we'll have probably the same kind of amount of demand we had before, if not less. So I think this is like a transitory thing. What else, like supply chains, but there has been a lot of disruption to supply chains and certain commodity prices have spiked. But as the global economy gets back to normal and China starts dumping commodities on the global market, which I'm sure they're keen to do again, we'll see the same kind of disinflationary forces that we've seen over the last 10 years. So I wouldn't want to be overly kind of relaxed about inflation. I think it could be something to worry about, but I think the real problem is like sorting out the structural scarring to the economy. Whole industries are now likely potentially changed and people's jobs may be lost. You've got to sort that out, and I think a Green New Deal is the way, making sure we are creating enough quality, socially useful jobs. I think it's an opportunity to be doing that, and that is getting that right is more important than worrying too much about temporary rise in inflation. And as I said before, the big kind of inflationary drivers still we've ignored, the places where inflation are happening in asset prices, in house prices. That is, what policymakers ignore. And yeah, that's, one of the reasons why the financial crisis was so bad, because we've kind of, taken the eye off what was happening to asset prices. And could, be a reason why we might have another financial crisis, because we don't see that as a problem in house, but we see it as a good thing if house prices go up. But to every rise in asset prices, there's a corresponding rise in debt for someone else. So, yeah, it's not a good thing.
Is there such thing as too much debt?
Depends what kind of debt, right?
Okay. So what sort of debt would you consider to be acceptable, and what sort of debt not?
I would broadly kind of distinguish between public and private debt. I think we can think of public debt as essentially like a claim on society almost. We have millions of taxpayers who, over decades and generations can pay the money back, and it's kind of like an investment. There's no problem having a lot of public debt if we're also getting, assets in return, right? If you invest in it, that's a sensible thing to do. Any business, if they want to improve themselves, will borrow to invest. So I think what you want to look at is really the kind of amount of interest the government is paying on its public debt to the private sector, essentially. And as we saw during the pandemic, even though we've seen record amounts of borrowing, the amount of interest paid on that debt actually fell because of record low interest rates. So if interest rates are low and the government can't default, there isn't a problem, which is where we are. Private debt, however, that is more of a problem. What private debt often leads to is a kind of, I believe the correct pronunciation is rentierism, or as I would usually call it, rentierism. So essentially private financial claims on the rest of the economy. And it leads to like a debt overhead where, huge increasing amounts of wealth and money in the economy are being siphoned off by the wealthy. So it's kind of financialization, that kind of problem of more and more of our money or of our kind of, productive output as an economy is going to paying off debt to wealthy people. That's not a good thing. That is like basically trickle up economics. So that's what I've been worried about, and I am worried about, and I think that's something we need to be talking a lot more about rather than public debt. And also that's where the seeds to a financial crisis. would lie. That's where the risk is. As we saw in 2008, it was private financial sector. Despite what the Tories told everyone, it wasn't the Labour government spending too much on the NHS, which bankrupt or crashed the economy. It was reckless speculation in the mortgage market and private finance, which crashed the economy. Though New Labour are without blame for laying the foundations of that, but that's another conversation.
Yeah. So you mentioned there that like large public debt isn't a problem. Now, to me, then, so if you're advocating for like a less growth focused economy at the very least, what happens to that debt? Like, does someone eventually have to pay for that? Like, are we saddling the next generations? Because this is something I see talked about.
Yeah, I mean, but that's usually a misunderstanding of how public borrowing works. These are essentially bonds that get rolled over. It's not like at some point the buck stops. You literally just issue a new bond to pay off that bond. It's, you can do it basically unlimited amounts as long as, people still have trust in the government. And, the government is able to, credibly, back its liabilities. I think people often misunderstand that. But I think there is a valid point in terms of like debt can create a growth imperative, right? So if there is a huge amount of debt, whether that's public or private, particularly private, that may create an imperative to grow the economy to pay off that debt. I mean, the bank, the government, if it can't pay off its debt, can always the Bank of England can monetize it. So just buy the debt off it, and in theory, there are no issues in that. I guess. Yeah, that's what you shouldn't be worried about, future generations. And, I think there's...
Screw them.
Well, I mean, to be fair, if I was a future generation as well, I would much prefer that my ancestors invested in saving the planet, and I would happily repay that debt, even if I had to, if I had to. But, as I say, it's not like... These are like government bonds essentially being rolled over, and the Bank of England can always monetize. So there isn't really a worry there. So I think the main thing you want to look at is just the amount of interest payments which are going to the private sector, and it's usually the wealthier people who own the government's debt. So it could be, arguably a kind of regressive transfer of wealth, like the government paying wealthy bondholders. But that's again something you can find other policy solutions to get around.
So what is money? This is something that I have discussed with quite a few people, talking in terms of mainly in discussions about cryptocurrency. And so what in your mind is what's money? What is it?
I think the way to explain that, or like to talk about this, is there are two competing theories of money, right? The commodity theory of money, this idea that money is something like gold. There's a scarce resource, and you think of it as like another kind of a factor of production, right? You need grain and infrastructure, but you also need money as well, and you need to get the money. And I think the common misconception people think about money is more in this kind of commodity theory of money. Like, if you ask someone where money comes from, they tend to think it's something to do with like the gold standard. Like, there's a limited amount of money which is tied to gold, and if someone wants more money, they have to trade with other people to get their money, essentially. Like, that's I asked my dad, like, where do you think money comes from? He said something about, I don't know, we trade with somewhere and we get their gold or something, and that's fair enough. Like, we're not really taught that, right? Like, I remember like doing GCSE business studies, and the teacher was asked about this, and she couldn't give an answer. She said something about the gold standard, which, as you may know, the gold standard hasn't existed since the 1970s. But there's still this popular conception that money is something to do with, there's like a you can't just create more of it. Like there's like a kind of fixed amount of it, and this is like the kind of narrative that the Tories and people who oppose the public spending say, there's not enough money, right? As if there's a finite pool that we draw from. That's one theory. So that's the commodity theory of money. There's also the credit theory of money, which I subscribe to, and it is more kind of shown in the reality of how the banking system works and the monetary system works. In that money is kind of a social relation which is created in the act of lending, essentially. So when banks lend, they don't take this existing pool of savings. They create new money, and then they are then issuing a liability against themselves, a kind of promise to pay. So money is essentially a promise to pay, and like it. I guess the reason people get confused about it is a promise to pay what? Like, because if you go to the Bank of England, you hand over your £10 note and be like, I want you to pay me. They'll just give you another £10 note. They won't give you silver or whatever they may have done in the olden days. So like money, like anyone can kind of. I think there's Hyman Minsky put it this way. The economist, anyone can create money. The problem is getting it accepted. So money is essentially like a circulating IOU, something that we can use as like a kind of something which allows trade, allows us to trade, and is created every day. There isn't a finite stock of it. It's just how much kind of trust we have in people will dictate how much of their money we're willing to accept, and all of that. But to like give a kind of proper definition of money, if that would also be useful. So like I guess the way a lot of people, the classical kind of explanation of money is talking about like the functions of money. And there are like three main functions. One is store of value. So money is something you hold, knowing that you can then consume at another point. So you can save it and then consume later, and its value will still hold. Then there's medium of exchange, which is something which can enable you to transact an exchange with someone, like a common kind of denominator that you can exchange with.
Yeah, like I'm gonna go for a beer afterwards, and I'm gonna have to hand over money in exchange for a nice cold pint.
And you could try bartering with something else, but money is like universally kind of accepted by everyone. So it's like a convenient means of exchange. And then there's unit of account. So money is what things are denominated in. The reason we use pounds is mostly because everything's denominated in pounds. So that makes it become a form of money. And this is where it gets into the point of where I don't think a lot of cryptocurrencies are actually money, because they tend to focus on the store of value function of money, which I think arguably is the least important function of money. If you want to store value, there are other assets to do. So to do that, and people who want, a lot of people like cryptocurrencies because they think similar to gold, there's a finite supply of it, so therefore its value will increase. Well, that's fine, but I wouldn't consider that the basis of the currency necessarily. I would consider that I like to own crypto assets, as other people often do, because if your whole use case for cryptocurrencies is that they don't they aren't as easily devalued, they increase in value over time, like why would you want to use it as a currency? Like if I can hold on to my cryptocurrency and just see it appreciate, why would I want to trade it for something which won't? And I'd rather use something else which would kind of depreciate to spend money. And like I think that's a real kind of challenge for like crypto. It's like,
okay, we'll get to crypto in a second. Just I want to finish the last point there, because you said there was three uses of money. There was
three functions
of money. Sorry, there was a store of value, a medium of exchange, and what's the third one?
Unit of account.
A unit of account.
So for something to be money, it has to meet all of those functions.
Okay.
So yeah.
So what, in your mind, gives it value? Because this is a discussion that my mum has had with me when she's asking me about cryptocurrency. And she's like, well, yeah, but it's just numbers, or it's just there. And I'm just like, my response is always just like, that's what money is.
Yeah.
At least, like, the pound is worth, to me at least anyway, is just as valuable as, say, a Bitcoin or a dogecoin, because it is based on the confidence that you have in it that you will be able to exchange it for something. To me, that's what it means. But maybe there's like a slightly different meaning or slightly different.
I mean, because when you think about, what are you exchanging cryptocurrencies for, like Dogecoin or Bitcoin? You're exchanging it for pounds.
Well, I mean, I've paid a few people in Cardano. Sure. That was real fun, actually.
I guess what distinguishes the pound as having value as a currency for me is that I can always reliably pay for goods and services in it. That's, whereas cryptocurrency, there's very few things I can realistically buy. And, even if I wanted to, for Bitcoin, for example, the transaction costs are really high, so I don't know why I would. Unless I wanted, there is a use case for potentially anonymous forms of payment. That's a good idea, I think. But there seem to be better forms like Monero or whatever people use these days. I'm not that up to date.
Privacy coins.
Yeah, for that function. I think that's a good function. But to for me, it's not really a currency if there aren't goods denominated in it. If you can't, the pound, it doesn't have innate value in that. It's only valuable in so much that you can convert it into pounds, which you can then convert into goods and services.
Okay.
If things were priced in crypto, more widely, I would be it's its own form of money. But for me, it's just a kind of shadow asset of you have to exchange it.
Gold or something.
It's not money in its own right.
Okay. So then would you say that so today, actually, or is it today? It's today. Today is the first day that Bitcoin is legal tender in El Salvador.
Yeah.
So they're running on a thing called the Lightning Network, which is built on top of the Bitcoin standard layer. And I'm sorry if I'm butchering this. Anyone who's listening who's better versed in this, this is just how I've had it explained to me. So that it's essentially it's built on top of it, and that it uses everyone having Lightning Network wallets in order to exchange the money across that without the monstrous transaction costs. So it's going to be you can be able to send it for the cost of pennies rather than the huge transaction fees. So say, for example, in El Salvador, that becomes quite widely used. I'm waiting for the Silicon Valley bros to move down there and gentrify a nice spot of it, and then I'll just go retire there. But would you then consider it, once it reaches the point where it's more widely used, say even in just one country, would you at that point consider perhaps even just that particular cryptocurrency to be money at that point?
If people are using it to transact for goods and services, and prices are denominated across the economy in it, I guess it would be more like a money. But I guess the other issue would be everyone else using the cryptocurrency would want to use it as an asset, essentially. So they'd be I feel like most of the people who invested into crypto, particularly Bitcoin, do so because they want the price to go up.
Yeah.
If
to the moon, I believe.
I think the main issue is if it did become a form of money, is how do you run an economy on that? Because especially with decentralization has its benefits in kind of transparency and accountability. But then if there's a problem, if you look, I think cryptocurrencies like Bitcoin have a tendency towards their kind of deflationary currency. If you need to basically increase the amount of money in the economy to get economic activity going, there's this classic kind of Keynesian policy. How would you do that if you can't, your monetary policy and by extent your fiscal policy and your democratic policy making as a country, you don't have much control over it, because whoever owns all the rest of the crypto, they have to agree to if you want to create more of it, or like, I don't know. I don't see it as like a democratic route. I'd rather the money I use in the economy is controlled by something accountable to the public. Maybe that's just my point of view, but I think El Salvador could get in a lot. I mean, El Salvador's got its own problems anyway, in that they rely on the dollar anyway, which they don't control. So this wouldn't necessarily be any worse than relying on the dollar, really. It may be like more volatile and, have other problems, but like ultimately at the end of the day, they won't have control over their own economic policy.
So you're basically saying that whilst there's a lot of critiques of like traditional fiat money, that the inherent value of it is that it can be controlled by a government who is theoretically, at least, under the control of like a populist, like a democratic nation, and that they can say, okay, well, we need more of this. We need you to print some money so that we can make solar panels, or we can, I don't know, we need more bus drivers, or the inherent value of like a fiat money supply is that they have the ability to turn it on and off in order to sort of prevent the sort of volatility that would come with.
The main thing you want to prevent is deflation. And, you just need to look at history.
Why?
That is like, so to explain deflation, it's essentially the value of money getting more valuable and the price of everything else becoming less valuable. So, I mean, the issue with this is that one person's kind of spending is another person's income. So if money is becoming more valuable, people will be more likely to try and hold on to it. Just like, as I said, with crypto, people don't want to use it as a means of exchange because they want to hold on to it. So economic activity stalls. And because
they're thinking, well, if I just hold on to this in a
month,
why would I use
more
my valuable?
Money? So that's like one way it's bad. I guess the other, I think, potentially more serious way it's bad is that like a reduction in prices. We're only looking at it at one side. We're looking at, okay, like our money can buy more, but the people selling you the goods are getting less in response, and then they no longer invest more. They lay people off. It basically means economic activity slumps, and like the value of debts become a lot bigger, right? Because, for instance, if you've taken out a £50,000 loan to fund your business, and you were selling things to pay for it, like a widget or whatever, a water bottle you're paying, you were selling those at like £10. If prices fall and it becomes more like you're now selling them for £5 or £8 or whatever, you have to sell a lot more to pay off that debt. So that debt is a lot bigger. So we saw this in the Great Depression, right? Most famously in the US, but also in the UK, when we tried to go back onto the gold standard under Winston Churchill in the 1920s. We essentially saw it was a terrible thing to do because, it sounds like a good idea in principle. My money's worth more, right? Like that's good for me. But your income becomes less because, your income relies on other people's payment. And essentially, it's really hard to get out of. So Japan has been battling with a depression or deflation since like they had a financial crisis in the 90s, and they never really recovered from it because it's just difficult to stop because people won't. It's hard to make people spend money if they think they can just hold on to the money and become wealthier and things like that. Like a deflationary spiral, most economists are more scared of than an inflationary spiral for a range of reasons. But I would say the main thing is that you need a growing kind of, or at least stable, if not growing, money supply in order for economic activity to be pursued essentially, and for people to be employed and for people to get incomes which they can then increase your income, because when they spend that increases your income and vice versa. So that's kind of maybe a bit of a fragmented kind of explanation. But it sounds intuitive, like inflation is bad, so maybe deflation is good. But I think we haven't really, there isn't really a kind of public understanding of why deflation is necessarily bad, because we haven't necessarily seen it since the 1920s in this country, and it was disastrous for the UK. Like industry collapsed, unemployment rose significantly, and that's what deflation does. So it's better to have inflation as long as people are still working, and if as long as people's pay is going up, it's not a problem. But of course you can have a spiral where people's pay goes up and then inflation goes up. But like at the end of the day, these are numbers, right? You can always kind of find solutions to that. And I guess the only people it necessarily hurts are people who've lent money. So the value of your like mortgage, for instance, for the bank is no longer worth as much. But it's good for you because your mortgage becomes a lot easier to pay off. It is complicated, but there are lots of different things. But I think essentially what you want to avoid is a deflationary monetary system. That's my worry of cryptocurrency. People who haven't learned the lessons of the gold standard and the problems of that, often trying to return to gold. But there was a very good reason we came off gold, because it didn't. It's not flexible enough to meet the needs of the economy. So you either have unemployment, or you have to revalue and devalue and stuff.
Well, thankfully, the internet's favorite cryptocurrency, Dogecoin, is an inflationary one. So so whenever that becomes the world standard,
does it just create more of them? There isn't a fixed supply.
Although it's less inflationary than the US dollar, which is a really interesting one, because people are like, oh, there's just millions of them being created all the time. When you work out like the total supply and how much gets created every year. Now I can't remember the exact figure.
It's huge. I mean, and it does make fiat currency sound bad, right? If it's just being created like huge amounts. And like you're right, there are like questions over accountability, over like who's creating it and where it's going. But I think really personally, and people might disagree with me, I think fiat currency is a pretty good invention in that it allows us to manage the economy a lot better than we would if we had like a fixed amount of money. As history shows. That's my point of view. I imagine people disagree if they're fans of cryptocurrency.
That's fine. That's what this literally entire endeavor of having this podcast is about, is getting different people's perspectives on stuff. To finish up then, do you want to tell people maybe where they can find Positive Money and some of the stuff that you guys do?
On all the usual places. So our website is positivemoney.org. We're on Twitter, I think, at Positive Money UK. We're on Facebook, Instagram. We'll sign up to our mailing list. We're keen to basically explore these issues and have debates and have conversations. Even if you've disagreed with what I've said, we're keen to still like challenge the kind of mainstream thinking, which we think serves all sides equally bad. It's been a pleasure to speak, and I look forward to hearing more of your podcast.
Yeah, no problem. Also, people, did you hear that? That is an excuse to get in touch and send angry emails to Positive Money.
Please do. I'm up for debate. I recognise not everyone agrees on these things, but we should have these debates.
Yeah, well, I mean, that's what my whole point basically about the entire world is. We got to talk to each other.
Yeah.
Thanks so much for listening. I really appreciate you tuning in and making it all the way to the end of the show. Please don't forget to like, share, and subscribe, and we'll see you next time. Thanks for listening.